You spent decades building equity in your home, but what if I told you that asset could be the key to a thriving retirement and not just a last resort? In this episode, I sat down with Matt Helton, a reverse mortgage specialist, to challenge everything that you think you know about Heckums, which are home equity conversion mortgages. Now, whether you're approaching retirement or already there, we cover how your home equity can become tax-free cash flow, reduce risk, and even increase what you leave behind to your kids. Matt breaks down some real-life examples in this conversation, from couples facing long-term care costs to high net worth retirees using Heckums to boost their legacy. So if you're house rich but cash poor, or if you're just curious about smarter ways to use your home equity, don't skip this episode. And with that, I hope you enjoy our conversation. Okay. Hey, Matt, thanks for joining me here. It's really great to have you. I'm looking forward to having this conversation about how you help folks with reverse mortgages and other things. So I just thought a good place to start would be, tell us just a little bit about who you work with, who reaches out to you, and what is it that you're helping them with?
Sure. Good question. We get a wide variety of inquiries. We'll get some from, 60 plus homeowners directly. We get some from kids that are trying to figure out how to best help mom and dad, so it's a wide range of people, but, kind of boil it down. We're mortgage lenders. So we do home loans. So nothing on a car, nothing unsecured, right? Only secured, mortgages. And then our specialty is really working with those folks that are 62 and older. There's some options for 55 and older, but not every state has that option. So really just working with 62 and older and just show them how they have tons of equity.
Yeah.
Unfortunately, equity doesn't pay for groceries, doesn't pay your property taxes, doesn't help you have a great retirement. Looks good on a balance sheet, but doesn't really help. And so we just show them how they can convert a small percentage of that equity into usable cash. And then the added byproduct is on most of our options, they actually don't have a required monthly payment. So you get to use some of the equity, still own your house, but not have a payment. And the added byproduct is that we have, seniors can just kind of have the retirement that they want to have without being strapped to a huge payment.
Right. And I'm glad you mentioned that because, I think my personal bias on this was that this is really kind of an option for, if you're really light on cash. And there's sometimes, a lot of my clients are, on track to pay off the mortgage. And so, but then you have some folks who, don't have a whole lot saved up, but they did make some progress on the mortgage. So they do have a lot of equity in the house. And so my thinking, I think up to this point has always been that this is just kind of a best option, if you needed it. Yeah. Is that a kind of unfair kind of way of looking at it?
For a good chunk of our clients, it is. You're describing it well. I call it a second chance for a lot of people. So it's I saw a stat the other day. It said that 70% of people are going to need long-term care, but only 7% of people got around for paying for long-term care insurance. We have a problem, Houston, a big problem, 63% of a problem, right?
Right.
So for example, you can use some of your home equity to prepare for long-term care, second chance at long-term care. And then a lot of people, almost everyone says, I should have saved more for retirement, but maybe they did. They just didn't call it a 401k with an automatic withdrawal. They called it a mortgage payment. And they didn't call it a stock market, 7 and 9% return. They called it a real estate market, 3% here, 2% here, 20% here, equity appreciation right in their home. So a lot of times it's their second chance at that 401k that they didn't save, but it's in the equity. So they can use some of it to offset the money they didn't. So we definitely see that a lot where it's like, okay, maybe you save some, but not enough. But then we do have clients that, affluent clients, where it's actually a more efficient way to use money. So, a lot of times if they'll have money in taxable accounts, right, they have to do the required minimum distributions, but maybe they're pulling extra money out and paying taxes on it. Well, the other option is if you use some of your home equity, this isn't income. It's just cash flow, and it's tax-free cash flow. So some seniors, when they run the numbers, it might make sense to use a tax-free asset than say a taxable asset. And then what happens is if you use less of your IRAs, your 401ks, your mutual funds, you just happen to pass on more of that, right? Because that stays in the market longer and grows.
Right.
So some people run the numbers and they pass on more money instead of less money to their family. We had a client where they actually had $2.5 million in their portfolio. They got together with a lady late in life. So he was like 82, she was 75. They met on that. I don't know if you've heard of this website. It's called Silver Singles That Want to Mingle. I don't know if you've ever been on that website.
No, but I can kind of imagine what it's.
Okay, gotcha. Well, they met there and got together, and then she always wanted to live in Florida. Well, that's where her family was from. He was from the Midwest, and his concern was he was leaving all of his money to the kids. And she only had Social Security. They were going to buy $850,000 home. Taxes and insurance are crazy in Florida. So he was worried that he's 7 years older. He passes away, leaves her with a big mortgage payment, leaves her with taxes and insurance and setting her up for failure. So he thought this made more sense for two reasons. One is instead of paying $850,000 cash for the home, he had to put half down. So he thought, well, I'm good at making money. So he likes to invest. So he wants to save his other $400,000 for investing. But also he wanted to not be burdened with a $5,000 or $6,000 a month mortgage payment and burden her with it, because on this mortgage, you don't have to make a payment.
Okay.
So for him, it made sense to keep his money in his investments and also not have a regular mortgage. And this gentleman was with his net worth was over $3 million with his real estate holdings, properties. He was buying and selling houses. He was doing all kinds of stuff. So for a lot of the sophisticated people to borrow money with no monthly payment, it actually makes sense as well.
Yeah. And let's take a moment to just maybe make sure that we explain exactly kind of what the mechanism is on the reverse mortgage and how that works. Yeah.
Yep. So the actual program that most people use, about 90+%, is actually called a Heckum, which is almost, if you catch the first two letters, HE is home equity. And then almost for most people, they've heard of HELOC, home equity line of credit. Well, this one's a little bit different. It's actually the CM stands for conversion mortgage. So it's home equity conversion mortgage is what it stands for. And it is a FHA mortgage. So I'm sure you and most of your listeners have heard of FHA before.
Yeah.
Well, there is the first time home buyer. How do you get your keys? How do you get in your house? How do you get life started? FHA that most people know about. But then there's the other side, which is, all right, you've got your keys, you've got some equity. How do we keep you in the house? And that's what this is. Not as well known, but just as important, right? How do you keep your keys? How do you have a good retirement? How do you have more money? So what they did was they studied HELOCs, so lines of credits, and then they studied reverse mortgages. And what they did was basically stuck them together. They took the best of HELOCs, the best of reverse mortgage, and got rid of the bad stuff.
Okay, interesting. Okay.
So, some of the challenges you've probably heard of with HELOCs are they're usually only good for in the ballpark of about 10 years. So most banks do 10 years. So if you take it out at 62, only pay the interest, you borrow $100,000. At 72, you get a letter in the mail that says, thanks for being a client, paying all this interest, but you still owe $100,000 and we need it next month. And if you're 62 years old living off Social Security, now you're 72, you probably don't have $100,000 just to write a check for it, or you wouldn't have done a HELOC in the first phase, right? So that doesn't work out well for seniors. And then also HELOCs will have that variable interest rate with that variable payment, which affects their budget, really hurts their cash flow. And then the third problem with HELOCs is banks can actually freeze them. So most people don't know that during 2008 and then during COVID, people were getting letters in the mail that would say, I know you think you have 100,000 available credit. You don't anymore. It's frozen. So those are some challenges that this program fixed. So there's no due date or ending date. So you never have to worry about the note being due. There's no payment required. So you don't have to worry about that variable rate and variable payment. And then it can never be taken away or frozen once the loan's closed. So it fixes all that. And then the reverse mortgage side, of people worried about, is this the loan where I'm going to lose my house, or is this the loan where I'm going to lose all my equity? And so since they're FHA mortgages on this scenario, you own the house, you could sell the house the day after closing. It's just like any other mortgage. There's the ownership, and then there's the mortgage. The client still owns the house. They just have a mortgage on it. They can sell it whenever they want. They can actually make payments if they want to, unlike old reverse mortgages. But then the neat thing about it is that they also can pass the home on to their family. So if something happens to them, it follows their will, it follows their trust, just like any other scenario. So to kind of boil it down is it's a regular mortgage with all the rules you've heard of mortgages, but with a flexible payment schedule. So you can pay $100, you can pay $500. Some people just pay the interest to keep the balance the same. Most people pay zero, because as you could guess, if you get a bill in the mail that says balance due of zero, how much are you going to pay?
Yeah.
Most people pay zero, right?
Yeah.
And that's the power. So I like to tell people it's a mortgage that gives you freedom of choice.
Okay. Now
you can pay whatever you want.
So you don't have a balance due. What is the benefit of making payments on it if you wanted to do that?
Yep. So we actually have people that more the complicated, affluent individuals will take out a mortgage. Mm-hmm. They'll let the interest build up for a few years, and maybe they have a taxable gain coming. Mm-hmm. So they could let the interest build up. Let's say they have a taxable IRA, and you advise them, hey, what if we could convert this to a Roth to get that tax-free money? Yeah. So they could convert it to their Roth, have the gain, and then they could write a big check to their mortgage. So they would get the equity in the mortgage and use that as a tax write-off to offset that. Gotcha. So things like that you can do. And then the other benefit would just be more whenever, let's say that people know that, hey, I want to do this for tax flow, but I'm only going to stay here 4 or 5 years. Mm. So I want to go ahead and make payments so that way I get more money when I sell the house.
Gotcha.
So because what you're doing is your house is making the payments for itself, basically. Your balance is going up. Yeah. And then you're using some of your equity. So whenever you sell the house, you're going to have a higher payoff, higher balance, and you're going to make less.
Gotcha. That's an interesting scenario I never really thought about with Roth conversions and paying for the tax withholding on that. Because, I know that generally the rule among us advisors is the best option is to pay for that money with cash set aside outside of retirement accounts.
Yep.
And then withhold it, as the next best option if you have to. But pulling the money out from equity, that's a very kind of creative way to solve the same problem. And so, and you're saying it doesn't. And I remember you mentioning this point in one of your other videos on your YouTube channel, where you're saying that you're not losing the equity when you go with this option. So how is that the case? Maybe it was because I was thinking of the traditional reverse mortgages.
Yeah.
How does that work where you're not losing? What does that mean when you're not losing equity, that you're still able to pull money out, monetize the house, but not?
Exactly. Yeah. So I like to say you're not losing equity, meaning a lot of people, they'll ask me, hey, is this that loan where you guys take my house, take my equity, and give it to Tom Selleck, if that makes sense? That's kind of the joke, right? The Tom Selleck commercials. Right. So that's what a lot of people think, that number one is we're giving them a little small amount of money. We own the house. We do all, it's just a regular mortgage. So if they have a mortgage, we're just paying off their mortgage, replacing it with a reverse mortgage, the FHA mortgage. And then they're not automatically losing equity, meaning that they have the ability to make payments if they want to.
Okay.
So that's where a lot of people, if we swap out, let's say they have a mortgage on the house, they pay it off, they refinance it. Well, they get a statement in the mail every month. If their biggest concern is their balance, they could actually get a statement in the mail. It says the interest is $501. They write a check for $501. The next month they owe the same amount. Because it could be an interest-only loan where they're not losing equity every month if they want to.
Gotcha.
For most people, though, once they pay their taxes, interest, mortgage, once they pay their bill, they have a pretty hefty payment. So if they can take that money and redistribute it to something else, we had a gentleman, he was making about $4,000 a month in retirement,
Mm-hmm.
part Social Security, part of it he was self-employed. He was still working his self-employed business. He had a $140,000 mortgage. Well, he was paying like $1,500 a month.
Mm-hmm.
So that was a huge percentage of his income.
Yeah.
So what we were able to do is come in, pay off his mortgage. So that payment went away. See, he automatically got about a 40% raise in cash flow in his monthly income.
Okay.
And then what his plan is to save that cash flow. His balance will go up a little bit, but he only owes like 140 on a $500,000 home.
Mm-hmm.
And then when he feels comfortable with his emergency fund, right? Because at this point he didn't feel good that if something bad happened, wouldn't have to go to credit cards, right? So now, well, that interest is going to build up a little bit, but his checking account's also building up. So his net worth is going to be, almost even.
Right.
And then his plan is to start making payments. But if you think about it, if he lives 15, 20 years and he owes $200,000 on the house, well, the house keeps going up in value in most scenarios. If it's worth $600,000 when he decides he needs to move on or gives the house to the kids, if they sell it for $600,000, they pay off $200,000, they're still doing pretty good. Does that make sense?
Yeah, and I'm glad you kind of anticipated my next question was, when you do decide to sell or pass it on to your heirs, is that where it kind of just nets out based on however much you borrowed and whatever payments you're making up to that point?
Exactly right. Yep.
Gotcha.
So the only really, if you're kind of looking for what's the negative here, what don't I understand is just if you never make that payment, that interest is just added to your balance.
Gotcha.
Right.
Gotcha.
Added to your balance. So that's where someone like you can come in and help people analyze and say, all right, so if you, like we had a client where we ran the numbers, they were going to pay $2,000 a month on their mortgage. Mm-hmm. So if they live 20 years, it's $24,000 a year. We did all the math. I mean, they're going to, over 10 years, they're going to pay $240,000 towards their house payment, right? $2,000. Well, on the other scenario, if they lived in the home 10 years, their balance was going to go up on their house. They were going to quote unquote lose about $100,000 in equity.
Right.
But they were saving $240 in cash flow. So I guess, would you advise your clients, hey, if you invest $100,000 and get $240 out, pretty good return, right?
Yeah,
and that's kind of the idea.
And it seems like it's also about we talked about unlocking the liquidity, the value, the equity in there that you can't use to pay your bills and take care of things, and it allows you to kind of, in a sense, kind of rearrange the order of things so that you can tap into the equity now and then pay it off
later
and make it work with your life cycle.
Sure.
In a sense,
You're exactly right. And then you could even have some of your clients, you may have met them early where they have a life insurance policy, right? So they maybe can't tap into the policy, but the policy could be enough as the balance goes up, whenever they pass away, it would go to the kids. The kids could have money to pay off all or a big chunk of the mortgage. And all of a sudden they've used all this equity, they've used all this money tax free, and then the home is transferred over to the kids free and clear because the life insurance has paid off the mortgage.
Gotcha. So then when you're applying then for the Heckum, is there like we talked about with the HELOCs, that the bank will just set a certain credit limit, right? How does it work there with the Heckum, and especially like you alluded to, over time, of course, your home value is going up, and so that presumably has some kind of effect on that over time as well?
Sure. Yeah. So I'd say our biggest challenge that we run across is the percentage that we can borrow, as you would probably call it, the loan amount, and loan to value percentage wise. So the government made a lot of changes after the financial crisis on everything, including these loans. They made the changes were so big that Wells Fargo and Bank of America used to be the top companies in this space, and they shut down overnight. Wow. They're like, we're out. It's And the reason why they did that is because they rolled back the percentage that we can lend to people are much lower than you probably would expect. And the idea is they always want people to have protection. They always want people to have equity in the home, and the government is actually on the hook for it, on the Heckum at least. They don't want to be holding the bag for a lot of upside down mortgages. So the percentages are based off your age. It's based off the value of the home, how much you owe, and it's also based off of interest rates. So as rates are higher now currently than the last few years, we can lend lower amounts. So to round numbers, if someone was, just qualifying, you actually begin to qualify on the Heckum at age 62.
Okay.
So if you were 62, you'd probably be able to borrow somewhere between 25 and 30% of the value of the home.
Gotcha.
So meaning if it was $1 million home, you maybe could have access to 250 to 300,000 if it was paid off.
Okay, and that answers another question, I think, which is that I was thinking of, who's kind of the ideal, or what's the best scenario to kind of prepare yourself for this. And it seems like this really works well for homeowners where they have already a good amount of equity, in their.
Yep. Yep. So it doesn't have to be paid off, because my example earlier, right? One benefit could be just wiping your mortgage out, so you don't have that big bill, your largest bill every month. But for other people, if it's paid off, then you can actually get some cash out to pay. There's no restriction. You can pay other bills off. You can work on your home. Some people want to actually retrofit the home for like age in place and railings and widened doorways, so they're going to be there long term. Those types. So you can use the money for whatever. But if you have a mortgage, our first thing we have to do is we have to pay off your mortgage is our number one priority.
Gotcha.
And then we can give you the excess money if it fits in there.
Gotcha. And as you said, the value of the home is going up over time. And so that means that the benefit of this also grows in terms of what you can tap into over time.
Yep. So the unlike a regular HELOC where, like you mentioned, you're like, this is what you can borrow, this is where you're at, it can only get worse and not better. On these, one of the cool things of we talked about second chance at long-term care insurance would be if someone wanted to be proactive, you could actually get one of these in place at age 62 and not even take any money, just have it in place. And the amount you can borrow actually grows annually. Similar to like you get those things in the mail that says, congratulations, your credit limit on your Visa, Southwest Airlines credit card has been increased, right? You didn't even ask them, they increased it.
Right.
That's the way these work. So every year, based on what the prevailing interest rates are, that it grows. So like if you borrowed $100,000, for example, today with no balance, give or take in about 10 years, the rule of 72 says that you would actually have about $200,000. It would double over 2 years. So if you got 400,000, it would be 800,000. So it actually grows. And then the neat thing about that is you can use it for whatever. So we have people that'll do that at an early age, early in this program is 62, let it compound. So if you do 100, you'll have like 107 and 115 and 125, 130, 140. And next thing you know, you've got access to $200,000 tax free.
Yeah, and I'm glad you mentioned the long-term care component too, because I made a note of that earlier when you mentioned that. And I know that's something that what I see with a lot of clients is the hope is that, hey, you pay off the mortgage and you got that asset in your back pocket, if you need to go into a home. But of course, it's always tricky with married couples, right? Because Papa goes into into the home and then, he's there for a couple of years and then Mama's by herself after he's gone and basically broke, and so I'm kind of interested in how do you see people using that to pay for long-term care? Because it seems like you might even be able to tap into the equity to maybe even pay for like a long-term care policy so that, you don't have to even tap it, sell the house to, to pay for that if it comes to that. Yeah.
So that would be probably your expertise to see at what age you could actually get qualified, for a long-term care policy and if the cost would make sense.
Yeah.
If you could buy a policy, but just to give you like an example, there's a couple of reasons why it's better to do it sooner rather than later is because number one is it's much easier to get money when you don't need it. And number two, when you need it, sometimes there's challenges, and either one could be qualification challenges or two, qualifications like financially, but also on these programs, we run into the mental qualifications of it. So we had a client, he actually called, he told me when I answered, he said, I can't believe you answered and I can't believe you do this loan. I said, what do you mean? He said, well, your friends at ABC Bank was the 22nd bank that I called looking for a reverse mortgage, and they gave me your number, and you're the only person I found that actually does this program. And the reason why he was so motivated is his wife had gone really quickly into dementia, And unfortunately, he was 80 and she was a mobile dementia. So she couldn't really think, couldn't really remember, but her body worked perfectly and she liked to pilfer through things. So they'd be sitting on the couch watching TV. He'd turn his back and next thing you know, she'd be in the bathroom rummaging through the cabinets.
Right.
So his concern was is if he fell at 80 and broke his hip chasing her around, you know, what's going to happen to her? How could he do so? But he didn't have, he had a lot of equity, but he didn't have the money to go, to have someone at his home because he didn't want to be driving back and forth to facility. And there's a lot of companies called in-home care where they'll do everything up to a shot, you know, besides they can bring doctors in, but they're not doctors, but they'll bathe you and take care of you. So what we were able to do is unlock his equity to get him in-home care. They're anywhere between, you know, sometimes $30 to $50 an hour. So that adds up after a while. But the problem with him, it took a while, is because his wife was an owner of the home. So she was on title. So he couldn't just go, he couldn't do this loan because when we go through the process, they would ask, who is this person? She's not dead. They're not divorced. And then she wasn't capable of signing any paperwork. And she also couldn't get through the counseling class. There's two parts to that. So he had to go through a conservatorship. Through the court. So basically a judge analyzed her, also analyzed doctor letters and said, yep, you are correct. She's not mentally there. I take her rights away on this property and I give it to you. So now you have your signature rights and you have her rights. So you can help.
And of course that
took a couple months.
Yeah. That's a process that takes time and money to get to do that, right? That's not going to happen overnight.
Exactly. So that's one of the reasons we get it a lot where people say, this sounds great, Matt. You know, if we ever need this, I'm glad it's there. And then we can't force anybody to do anything, but I just tell them stories like that. Say, well, when you need it, sometimes it's too late. Just like that long-term care insurance that you just told me you wish you would have bought. Because you just found out how expensive it is if you ever need long-term care. You know, so that's kind of the pro. And then the other side is a lot of times you can do this while you're working because it's easier to qualify versus if you're just making Social Security, it's easier to qualify for these than regular mortgages. But, you know, depending on the part of the country, the taxes, the insurance, the HOA, we have to do some financial qualification. And if you're not making, if you're doing average Social Security of $1,976 a month, it's hard to qualify sometimes.
Gotcha. So I imagine there's some people who probably will sign up for this, park the money if they don't need it in some kind of other interest-bearing account, maybe even invest it, and that way, you know, if you never end up needing it later, you've grown that money to help pay for that, and you're back to, you know, it's kind of square one in terms of.
You're exactly right, Part. Yep, they could do that, or they could also just set it up as a line of credit and not borrow very much. At the beginning, as well. Right. Good question. Yeah. So in your position then, I mean, because you're serving seniors, you see a lot of people coming to retirement. You, like me, I mean, we talk to so many people every single day, right? And so it's almost like an ongoing research project where you're just getting this growing sample, and it's interesting to see what happens at the averages as, you know, the number of people you talk to increases. And so I know you spend a lot of time also talking about what a thriving, you know, kind of retirement looks like. And I'm kind of a fan of Charlie Munger's kind of inversion, you know, technique. And so I always like to think first of, let's look at the horror stories, the negative side of that, and what you've seen in terms of those kinds of patterns of when people show up to retirement, and it's basically the worst case scenario. And what have you seen? What have you learned just over the years? You know, I'd say the couple things that we've learned, just looking at things, are number one is that people so infrequently change their habits after a certain age that they write books about them and make movies about them, right? So you just don't wake up at 50, 60, 70 years old and all of a sudden start saving money or paying your bills or those type of things, you know. So that is probably the biggest thing that we notice is that this gives people, like I mentioned earlier, a second chance because they were forced to, because in your line of work, right, most of the time you're like, all right, guys, it's coming. It's a train. It's coming down the track. It's called retirement. You better prepare for it. But they don't have to, right? They're not forced to. And most people get it a little bit, but most people are undersaved and underprepared. You know, they ran their numbers off the A1 optimum scenario, and A1 optimum scenario happens about this percentage of time, right?
Yeah.
So I think that's probably one of the horror story side of it is that, people at a certain age, you kind of are what you are. Unfortunately, now we do have outliers and we have, those type of people, but like, Colonel Sanders starts KFC in the 60s, right?
Yeah.
He's super famous, not because he did that. He's super famous because no one else does that at 60, right? It's hard to. So I would say, that's one of the things we've definitely noticed. We see it, over and over, where people don't pay their bills at an early age. They don't pay their bills at a middle age. They don't pay their bills later in life, but they do have to live somewhere. And last time I checked, it's better with a roof than it is without a roof. Right. So a lot of them were forced to make those mortgage payments, and that's kind of why this has been a really good solution to kind of save a lot of people's golden years.
Yeah.
If that makes sense.
Absolutely. And to switch to kind of the more positive side of the coin, I imagine you talk to a lot of people after they've retired, and it's interesting to kind of hear their experience versus what they expected. And have you had any interesting conversations around that, or have you heard anything interesting that people have shared with you about?
Yeah, I have. We had on my podcast, I had Sin Meyer, which her group's called Second Wind, and she's basically a life coach for seniors. And she has a lot of people that were either expecting one thing in retirement with something else, or they were expecting retirement with their significant other, and unfortunately they made it, and their significant other didn't make it to retirement like they'd hoped, or they didn't make it there in good health.
Right.
And so she talks a lot about just coaching people through, hey, how to get the best out of what you got left. It is what it is, right? We've got here, but she just talks about, and her thing's called Second Wind. So how do you get your second wind, and how do you get something out of retirement? Because it may not be what you were expecting, but it still can be great, right? I mean, we have a lot of things in life that we were expecting one thing, it ends up being something else. A lot of times something else is even better than we thought we were going to get.
Right.
So I think that's what and then a lot of times we see people they think that it's, we always want something else. Like, so when we're working our butt off, we're just like, oh, I can't wait till I'm old, retired, and don't have to do anything. And then we talk to these seniors and they're like, I wish I had something to do. It's like we haven't figured out how to be happy where we are and need to be happy with our tasks. And then so a lot of the seniors, if they don't have a hobby or they don't have people to spend time with, it can be challenging. So there's a couple groups that we recommend. There's one in-home care company called Seniors Helping Seniors, and they actually look for healthy seniors that want to be, they're not doing all kinds of crazy medical things. They're just spending time with them, doing small tasks around, but they're getting purpose. They're getting accountability. They have to be somewhere. They have a schedule, which we think sounds bad, but that sounds good to them because they've been off schedule for so long. So that's what I see quite a bit is people need something to do, and they need something to fight for every day, a reason why I get up.
Yeah, you still got to have a purpose. I mean, you're retired, you're not dead yet, so as long as you're alive,
exactly.
You got to have a reason to wake up. That reminds me of, there's a financial advisor I listen to who always recommends his clients do what he calls a retirement rehearsal, which is just a staycation. You take a couple of weeks off, but you don't go anywhere. You stay home and you just kind of see what it's like to be retired.
Nice. That's awesome.
Yeah. And that way you can kind of see what you don't see, and you're expecting that there's, you might have certain ideas about, hey, what your retirement schedule is going to look like, but there's actually a lot of time you have to fill up. And when you get done with all those, with that long honey-do list, that, backlog maintenance, then you're going to be pretty bored, or you're going to have a pretty clean slate. So, once you work through that, first 6 months or so, it might kill, your time there. But after that, then you got to figure out what to do next. And so,
no, that's awesome.
Yeah, it's a retirement rehearsal.
Well said. Yeah, that's well said.
Yeah, like a little test of retirement. So, let's mention your YouTube and podcast where people can find you, to make sure that.
Sure. Yeah, thanks. Yeah, if you just go to YouTube and you type in Serving Senior Podcast, type in my name, Matt Helton, I'll pull up, and we've videos from professionals that everything from in-home care to life planning strategies to care client coordinators. That's a mouthful, as well as videos about what we do as well. So please check that out, and feel free to share that with anyone in the retirement planning phase. We want to add value because we're not really in the mortgage business. That's kind of what keeps the lights on. We're in the business of giving people peace of mind and just letting them know there's other solutions and other options. And unfortunately, a lot of people have concerns about retirement, concerns about money, concerns about their health. So we want to just share this story that, hey, there's resources out there. There's great information. You don't have to lose sleep. You don't have to worry about your retirement because there's great people out there that can help you have peace of mind.
And I know you're based in the Nashville area. Can you work with anyone anywhere, or are there any restrictions on that?
Yeah, so my company I work with is nationwide. Okay. So if there's anyone that needs some help in an area that we don't work, we can get them to the right people. Awesome. People that have common hearts for service and common hearts for taking good care of people.
Okay. And tell us a little bit about you. From what I gathered, you're a big Titans fan, and but you're married, you got a family there.
So I have a 14, 12, and 8-year-old.
Okay.
And we just got through a couple. I believe the graduation people figured out how to sell us more stuff. We just had a 6th grade graduation, an 8th grade graduation. I feel like a 2nd grade graduation. They've learned how to sell us a bunch of caps and gowns every single year.
Oh,
but we got them all graduated and off to the summertime.
Well, for us, I mean, it's parties. So there's gifts you got to buy to go take, or if you're hosting, you got to pay for all the food and all that stuff. So it definitely gets expensive. It's like weddings,
Yeah, exactly.
Awesome.
Yeah, thanks for asking. Yep. So we're in middle Tennessee. We branch out sometimes, like to go to the Caribbean, like to go to Florida, like to go to the beach. But most of the time we're just around here shuttling kids around from ball practice to dance to friend's house, all that fun time, crazy time, but fun time of life.
All stuff I'm going to be looking forward to is because mine are going to be 5 and 3 this year. So
that's awesome.
You're definitely shuttling them around everywhere.
Yeah,
they're not
exactly right, and it's safer. We just had one. They thought he was Evil Knievel, and he ripped off half of his chin on the bike. So I heard he did two backflips and a cartwheel off the bike and woke up in the street. So he's recovering, but he's well on his way to recovery. They heal a lot faster than we do at that age.
I guess it compensates for the fearlessness.
Exactly.
Thankfully my girls aren't that fearless.
That's awesome. That's awesome. Well, I really appreciate you having me on, and any chance we get to share what we do, we love to spread the message.
Yeah, and a lot of my clients are Ramsey fans and listeners, and I imagine you talk to a lot of folks who know him and have some kind of opinion about him. But like I said, I know that sometimes this is something that's needed, in certain situations, and it can want to know what tools are available.
Oh yeah, no, most definitely, yeah. Dave Ramsey doesn't like traditional mortgages, let alone reverse mortgages. Yeah. If that makes sense. Yeah. So this would be this is just an alternative strategy. It is not the only strategy. Yeah. It's not the strategy. It's just a strategy. But before we run, I kind of boil it down to the basics. You've got this much money in the bank. You've got this much equity buried in your backyard. All we do is just show people, it's like, hey, would life be a little bit better if you could unlock some of that? All right, well, let's analyze. Is it best for you to do a HELOC? Is it best for you to do a regular mortgage, which would include a 15-year, a 30-year? Is it best to do one of these Heckum reverse mortgages? And we just kind of go through the pros and cons of each one. And half the time, it is what Dave Ramsey says. It's, you shouldn't touch it. Let's pay it off. Let's get it done, right? Yeah. Let's pay it off. And then the other half the time, when we look at it, if it's a tax-free, no monthly payment required, it may make sense because you may actually give your kids more money than less money because you're not dragging the portfolio down, right? It's like no one ever says, you know what, that was a really dumb idea. I can't believe you pulled money from your 401k every month after retirement, right? No one ever says that because that's what it's for. They think, well, this is just like this is just a 401k you happen to live in.
Yeah.
You just happen to get some money out of it. Oh, by the way, it's allowed you to leave more money in the 401k. So it's growing.
Yeah.
It's allowed your advisor to be a better steward of that, right? So it's just a different way of thinking, not right or wrong.
Yeah.
Just a different way of looking at it, which may be right for some people.
Yeah, I mean, it just goes to me. It kind of goes back to the problem is that you have this value in this asset that is trapped in there, and how do you get it out? How can you monetize it? And that's what's dictating what options are available, for you.
Exactly.
Yeah.
You're exactly right. It's just an asset you happen to live in. And it also, the other neat thing about it is people will say things like, that sounds risky, I always most of the time when they say that, they have a mortgage. So I usually just ask them, well, tell me about, who's your loan with? And they give me a name of a bank. So, well, say that your portfolio crashes. Let's say that you get sick, and let's say you can't make the next 3 mortgage payments on your house in your current situation. What would happen? Oh, geez, I don't even want to think about that. I was like, well, I don't want to think about it either, but what would happen? Well, I don't know. I guess they'd probably put a sign in the yard and try to sell it out from underneath us. Like, that's legitimately what would happen. I said, well, if you wiped out your mortgage and you put one of these in place, and then you decided not to, or something happened and you weren't able to pay 3 payments on this type of loan, what do you think would happen? And they're always just like, well, I thought that's what we're talking about. Like, I thought that's why we're talking about this, right? I don't have to make a payment.
Yeah.
I was like, well, exactly. So which sounds riskier, missing 3 payments and someone selling your house, or missing 3 payments and that's actually part of the program of what you're supposed to do? And they're always like, oh, huh. And then just kind of reconsider, right?
Yeah.
What's risky? It's on, what are they saying today? Fake news.
Yeah.
It's almost like most of the things that you hear about, at least this current iteration of a reverse mortgage, a lot of it is the opposite of what you're hearing out there in the world.
Yeah, and that what that highlights to me too is that with the regular mortgage, the bank holds the liability side, I guess, and you hold the equity. But here with the Heckum, it's kind of like you hold both. And
it's a mandatory obligation. This is a non-mandatory, right? It's kind of self-directed. You can decide if you want to make payments.
Right. So it's not as I guess as adversarial kind of a relationship as you have like with your bank, where it's a zero-sum game, I guess, between the two.
Yep.
Right.
So on these, all you have to do, and people will say, well, that's not totally true. I heard I still have to pay the taxes and insurance. I was like, well, if your home's paid off, you still have to pay the taxes and insurance, right?
Yeah.
It's the same thing. So your home basically performs like it's paid off.
Yeah.
You don't have to make a mortgage payment, but you have to pay your taxes and insurance just like you would if your home was free and clear.
Awesome. Good points. Well, we will. I'll make sure to include links in the podcast show notes and in the YouTube description to make sure people have a way to get to you. And
sure,
maybe we can come back around and do this again, down the road. But I appreciate you.
That would be awesome.
Yeah,
thank you so much. Yeah, we did a lot of conceptual. Maybe sometime we could pick here's how it works for a purchase, because people use these to sell a home, make some money, but not have enough to pay cash. So we can do a reverse mortgage purchase, sell a home, put a big down payment, and do it and we could do an example of maybe go through the numbers on a refinance, how it could work, kind of some case studies.
That would be fantastic, because especially me being here in California, definitely talk to a lot of people who, as part of the plan for retirement, they're thinking about moving out of state and going somewhere else. And so, they got to definitely plan that transition, figure out, okay, how do I, land in the next house, and what does the equity and, all that look like,
Yep.
So
makes sense.
Yeah.
Anything we could do to help people plan, we're up for it.
Absolutely. Well, thanks again for coming on, just kind of walking us through all this. And I think it's very informative for anyone who's going to be coming across this, and really just maybe hearing it probably for the first time, so I think it's a good primer for them. But yeah, thanks. I appreciate your time. Thanks again for coming on.
Thanks for having me, buddy. I really appreciate you.
Yeah.